Okay, amazing. Thank you guys so much for coming and listening. My name is Irene Wu, and I am a venture partner at Bain Capital Crypto. Most recently, I was head of strategy at Layer Zero, which is an infrastructure protocol within our space. We're very lucky to have 4 people who have either founded and built or are currently leading the most enduring infrastructure and really early real-world asset companies, and they each lend a fairly unique perspective. So first we have Michael, founder and CEO of Fireblocks, a digital asset infrastructure company with a very unique vantage point to what venture capital firms and financial institutions are building and distributing across the space. We then have Andrew from Republic, which is a digital merchant bank, or you could think of as Goldman Sachs on chain, has evolved quite a bit, has an interesting lens on certainly what's next and a view on culture. We also have Nathan, one of the founders and CEO of Anchorage Digital, an integrated regulatory financial infrastructure firm, also involved in many different aspects of real-world assets. And then Larry Wade, who leads risk and compliance across many different groups at PayPal, including their digital currency group in particular. Thank you all so much for coming. I want to start the panel by setting a scene, which I'm sure other moderators have brought up this day, which is the very large and landmark bridge acquisition by Stripe for $1.1 billion. And there's sort of been like a thawing of the ice and reawakening of the traditional financial industry to stablecoins. Some say this is a real watershed moment. I'm curious if you guys actually consider this to be an inflection point or more another data point across other validation you've seen. Perhaps, Michael, you can begin with what Fireblocks has been privy to over the last few years in regards to adoption.
Yeah, sure. So I think it's sort of like a data point, to be fair. Bridge has been our client for just like a year or so. So, you know, I kind of understand why, and Stripe is actually an investor in Fireblocks, so we kind of understand why this acquisition came to be. And I think it's basically a data point, right? I think that stable coins, or basically digital money, it is one of the areas that we have true PMF at scale of tokenization. Just to give folks some idea, this year we will process about $1.2 trillion of stablecoin that will go through our infrastructure, and basically like half of it is done for settlements of trading, but the other half, and it's like a very large amount, it's a lot of PSPs that are similar to Bridge that are doing settlements across various corridors, especially cross-border. So it is a data point where you see kind of like the most marquee PSP coming in and grabbing one of the best assets that are able to do this function. And I think what we will see, and definitely like, you know, what we're seeing is it's actually creating a strong FOMO across the competitors of Stripe. So, yeah.
I think people often take for granted that for us to get to the point today where we can say stablecoins have achieved true product market fit is a lot of the risk hurdles and regulatory hurdles that shadow workers like Larry have had to invent. I'm curious from your perspective, PayPal launched PYUSD recently. That is a huge feat. How much of a feat is that? Like really set the scene here and describe for us the kind of work your team had to contribute to make that happen.
Yeah, well, one, really excited to be here. And this is not hyperbole. It was the hardest thing I have ever been a part of in my entire career. And I was a management consultant prior to going to PayPal, so I've seen some crazy things. There is an actual visceral reaction that you get from regulators, government officials, when you're, you know, the largest fintech in America by market cap, and you say you want to launch a stablecoin. So, I mean, tons of education, internally and externally. I like to use what I call the zip code method. And I've been saying this for about 3.5 years now, and it's kind of, I think it's helpful. You have a group of stakeholders that say, this is all net new. So everything that happened before is not useful. And then you have another group that says, hey, we've done all these things, fit it all in there. And really, it's more so this, how do you find the proper zip code? That way, then you can find that address. So it's like 80% of what I leverage are tried and true risk and compliance related strategies. And then that 20% is very unique, exciting, that net new. Again, for example, we don't support ERC20s, but an ERC20 can come to an Ethereum address. When we launch transfers, we have Ethereum. What happens if Ethereum Classic shows up? I have to think about stuff like that, which is really cool. But very hard, lots of education. We tried multiple times, and getting it through, I think, was well worth the fight. And now we're just trying to figure out how to utilize it. Specifically, obviously, in our network, we have 400 million wallets in 200 countries, but just to really bring utility to the market.
Before we move on to slightly more exotic real-world assets, on the topic of stablecoins, I'm curious, from both of your perspectives, Republic and also Anchorage, do you think we've reached endgame success with stablecoins? And if not, what are elements of the distribution, for example, that both of your teams are thinking about and investing R&D resources into?
You're going to see a lot of stable coins pop up over the next 6 months, hundreds of them.
Competitive ones based on the US dollar?
The reality is Tether is the most profitable company on the planet per head count, and everyone has gotten pretty wise to that. You want to be in the origination side of the business. Everyone is running in that direction, right? If you look at BlackRock, they're pushing their own product out. I mean, they're even trying to leverage it into Binance at this point. You're going to see hundreds of stable coins coming up from banks, players, sovereigns, could be anything, and it's not going to stop. And so it's going to become a really interesting time in the space between all those different assets and how those assets will be managed, how they're going to interact with each other, who will use them, who won't use them, and there's probably a fair amount of politics that are involved in it as well. So I'd stay tuned for that. But and then when you look at the U.S. and some of the regulatory bills going through U.S., like stablecoin is very much at the top of the mark there, and that is really important to the discussion because it's giving some level of clarity for people and making people comfortable with running into that direction, just like PayPal, right? So, they're certainly wise to that, and, applaud to you for doing that work and getting there. I think it will pay dividends for you guys, but yeah, you're going to see hundreds of them, no doubt about it.
And then how about from the Anchorage perspective? There's more and more stable coins. What's perhaps changing from your team's perspective on what you're investing in?
Yeah, so just to say hi, I'm Nathan, co-founder and CEO of Anchorage. We're a digital asset custodian and get to participate in a lot of the ecosystem, work closely with everybody here on stage. And one of the things we're seeing actually earlier in my career, as an example of how big I think the stablecoin opportunity is, I worked at a company that used to be called Square, is now called Block, and we launched this product called Square Cash. And it was a peer-to-peer payment mechanism. So somebody could send money to someone else. And we launched this at the time when Venmo was already dominant. And Venmo was already proliferated among the US. And so we asked ourselves, what is the way to actually grow Square Cash? And it turned out that the people to go after were the unbanked. And so the specific Square Cash strategy was to pick a segment of the market that was systematically underserved, go after that, and the success now of Square Cash, which is a big part of the contribution margin to the overall Block entity, is because of that idea of going after the unbanked. And that was just for dollars on a fintech within the US. Stablecoin takes that idea and applies it to the entire planet. Yep. And so the opportunity for stablecoins is immeasurable right now. We were really talking about it like an M1 type opportunity where this product set can go to every corner of the globe in a way that is unmatched by any current fintech product right now. So if we fast forward 5-10 years, I expect that most of the block space on the top blockchains in the world will be taken by stablecoin-based use cases, stablecoin-based infrastructure, and I think we're at the very, very early innings of what that looks like. We need far more fair stablecoins to be released. We need far more distributive stablecoins to be released, and so it's very early on, and I think there's a ton of opportunity in that space.
And when Nathan says fair stablecoins, if I can add my perspective, having been on the operating side at Layer 0 and now at Bain Crypto, I interpret that as stablecoins which perhaps share the yield or distribution rewards and benefits with its partners, which might be DeFi protocols, it might be financial institutions, applications. Not all stablecoins are created equal. And in that respect, one thing I'm curious to talk more about is the traction around money market funds. Michael and I were talking about this backstage. Fireblocks has been able to work closely with some very surprising but like accelerative initiatives like BlackRock's BUIDL program. Can you share what you guys have seen? And then also, did Fireblocks have to build new infrastructure to support this?
So no, we basically like we have a product that well, yes and no. We actually did an acquisition about a year ago of tokenization infrastructure, company that was called Blockfold, and we now have a tokenization platform. So on the back of that, people can issue assets, and they can basically import smart contracts and manage the life cycle. Now, that platform itself actually doesn't include the regulatory licenses, right? So we're currently working in various permutation of that with the likes of, again, like BUIDL, we work with Securitize, that is basically the transfer agent behind BUIDL. We're working with WisdomTree, we're working with Hashnote, certain capacity, we're also working with Ondo, and then there's like a lot of other folks on the international markets that are doing similar things. I think it's quite interesting because, to your point, once we're getting stable coins into circulation, right, and people are sitting on large balances of stable coin, the next question, and I don't remember who, you mentioned it, right, that Tether is the most profitable company per employee on the planet. The next thing that you're basically thinking to yourself, if I have USDC or I have USDT, why that 4.5% of what I'm holding is going to one of those two companies, right? How do I get it, right? And right now, again, there are stable coins that are coming in with certain techniques of how to distribute it as part of the actual stable coin back to the user, but the well understood regulatory technique is really the money market funds, right? So I basically would like take that stable coin, I will invest it in the money market fund, and the money market fund, whoever the asset manager that is managing it, they will hold some management fees that are currently, well, depends how much you negotiate, somewhere between 16 to 40 basis points, still much better than 4%, and the rest goes to you, right? And I think, like, what we are basically seeing is that this is kind of like, the next PMF that starts to emerge. So it's not huge. I think right now the tokenized money market fund opportunity is around 2.5 billion, which is still like a fraction of the 180 billion of the stablecoin market. But there are clearly, like, two use cases that are emerging. The first one that I think most of those folks are going after is really the collateral use case. So the best example is that I'm trading on Deribit, right? Right now I'm funding my trade with USDT or USDC. That doesn't earn me anything. And if I'm basically depositing something that is, which just was announced last week, that Hashnote is available on Deribit and then QCP and a few other folks, right? Then I'm starting to basically get another 4% yield on that. And that is actually, I think, a use case that can also traverse outside of crypto. So that's like one use case. And the second use case is really to manage treasuries. We've tried it ourselves. Actually, last week was investing the USDC we have on our balance sheet into BUIDL. It was a pretty nice experience. And I think that specifically for foundations and a lot of like on-chain entities, it makes a lot of sense, right? If you basically have stable coins and you want to be in dollars, but you want to basically get the interest.
So for many of these users, and we'll unpack, for example, who is actually using these tokenized money market funds, they already have assets, typically non-yield-bearing stables on-chain, and rather than off-ramping and then investing into some other yield-bearing structure, they can have exposure through assets like BlackRock's BUIDL. Is that fair to say?
Yeah, well, basically, like, it is like the most conservative investment that you can make, which is not always lands well in the crypto crowd, right? But if you are conservative and you want to still make money on, if you want to stay in dollars, you want to stay on chain, this is probably the best solution you have right now without running into something that is like a very risky product.
I think the expectations of users in the crypto native space, which is where I have spent most of my time, and also in the institutional space, which is where you all in suits sort of have spent a lot of time, are all turning towards a yield, like very, very high expectations for that, even for passive assets. Republic is particularly interested in tokenized culture assets, which I think are quite exotic, and there are a lot of unknowns around what yield there could look like, but maybe it's even more of a resonance around simply assets which users, people interact with in other ways. Can you speak on this thesis and how perhaps this makes sense today in 2024, but maybe wouldn't have taken off in 2022?
Yeah, I mean, for us, it's really only recent that the RWA space has started to make a lot of sense. We've been in it for 6+ years, but it's only now that you're starting to see the different layers all aggregate together that make it viable, particularly when we look at, let's say, culture assets as an example.
And define culture assets.
Yeah, so I mean, for us right now, we have a lot of focus on the tokenization of sports, film, music, art.
IP.
Yeah, and it's the equity in these things. It's true equity. For the most part, securities have not changed for like 100 years. They've basically stayed the same. But through tokenization, you have the ability to add utilities into these different assets. So when we look at sports teams, we can take, and we've done this, and this is not theoretical or conceptual, we're doing this at scale now. You can take 10% of a sports team, take the equity, convert it into tokens, and build utilities into it, and sell that to retail and institutional investors. Have a certain amount of tokens, you can meet the players, travel with the team, have your own entrance to the stadium. And so when we look at tokenizations, it's not just the financial instrument, it's the ability to deliver an asset class that previously was unattainable to nearly everybody, right? And even for an accredited investor, if you wanted to own a portion of an NFL team, it wasn't going to happen, right? And so now we're looking at that. That's a reality that we're seeing on a regular basis. So the reason it's viable is you've started to see the consolidation or the vertical integration of the things required to make that happen. Previously, literally 2 years ago, if you wanted to interact with a security token, you'd have to work with 5 different vendors. You'd have to work with a tokenization platform. You'd have to work with a primary issuance platform. You'd have to work with a custodian, like either of these guys. You'd have to work with a transfer agent. You'd have to work with a wallet company. You'd have to work with a secondary market. These are all different businesses that have different goals, initiatives, and directions, and it was a very difficult process. For an institution, impossible, because you'd have to pass KYC on all these different platforms and go through your third-party compliance committee to make sure that everyone is comfortable with it. So now only recently have you started to see the integration of these different business lines that make it so you literally only have to pass KYC once or create one account. Very similar to what Fidelity did or Morgan Stanley did when they brought the primary brokerage to the retail space.
So as with most subcategories of infrastructure across tech, it sounds like a key consolidation that occurred over the last 2 years, which, like Fireblocks and Anchorage have done, enables integrated solutions. That's actually what now allows innovative tokenization and democratization of assets like music IP or ownership of sports teams. Is that
If you
correct?
had to work with 5 people to buy an iPhone, you would just never buy an iPhone. It's just the reality of it. So it's just really the maturation of the space and the maturation of the technology that allows for that to even happen.
From a leadership perspective, Nathan and Larry, over the last 2 years, what has informed some of the decisions around the growth of your company, some of the areas where you actually invest time and attention, and have all of those hypotheses been proven correct?
Yeah, this is a really important one because there are a lot of things going on in crypto and blockchain generally. It's a very narrative-driven environment. And so at some level, to think about like kind of where you go next, what you tend to focus on, you actually have to have quite a lot of conviction. And the conviction is to not work on everything and only to work on, say, the certain things that matter a lot. Real world assets have been a big one for us. Right now, I believe we are the largest custodian of both BUIDL and USTB, the on-chain tokenized money market funds. And so we're making a big effort to focus on that because we think this is a precursor to a very large movement. I talked earlier about dollar-based stablecoins being a very big opportunity for the globe, really in a really big way. But I think the tokenized money markets being the first foray into bringing assets on chain. And around what Republic is doing is like it's not really enough to just kind of bring them on chain. There should be more utility. It should be more interesting if they're on chain. They should settle faster. They should have less counterparty risk. I'm sure many people here know that there were victory laps done over the last year about moving to T+1. And it's kind of laughable to those of us in crypto because T+0 is possible in terms of settlement of assets. And so this like systematic reduction of risk in the markets, more utility being added onto these assets, all the stuff that kind of the DeFi ecosystems understand intuitively about on-chain interactions that you're able to do, fully automatic, counterparty riskless transactions that are now possible. All of that ought to be able to come to a lot of what we consider the traditional assets out in the world, and these money markets as just being the first incarnation of that is really exciting. But it's the beginning of I think a much larger trend, and I think the leadership there is about how do we not rebuild the same thing that we already have, but actually go for something that is 10 times better. Right now, stablecoins are 10 times better. Tokenized money market funds are maybe 5 times better. And so I think there's more work to do, but there's a lot of infrastructure that can be built. And then once all that infrastructure comes together very nicely, we get to the nirvana world where you can kind of have integrated stacks that can do a lot of stuff and do a lot of stuff really well. So looking forward to that.
And that's a hard thing because the natural state is to just try to rebuild a better thing that already exists, right? And it's going to take a lot of people pushing a lot of innovative and aggressive thought ultimately to kind of break through that barrier.
Absolutely.
Yeah, and at PayPal, it's interesting because the Blockchain, Crypto, and Digital Currencies Group was a startup within the PayPal mothership. So ultimately, you need to protect that brand and not contaminate the core business, right? Specifically from like a reg and risk perspective. We take a very, very collaborative approach. So risk and compliance, legal, engineering, product, business development, all coming to the table very early in the product life cycle. So product director will come and say, hey, we're thinking of this. One, all utility as well. So our CEO of our group, Jose, he likes to say, market cap is great, but that's a very static measure. We want to see transactions. We want the stable coin used, for example, right? So does it have utility? What type of problem is it solving? Is it more low-hanging fruit? Is it one of those mid, or is it one of the big ones? And we have that on our roadmap, but we're trying to get little wins along the way while simultaneously building out the more complex initiatives. And that also helps with narrative. To your point, this is all about the story, internally and externally. So again, coming to the table early, I like to say, as the head of risk and compliance, I am trying to figure out how to get you guys to yes. If I say no, it is because I cannot see a viable way forward. So thinking of it from reg perspective, risk and compliance perspective, the utility perspective, that's how we go about it at PayPal.
How big is the team at PayPal, the crypto team?
For our crypto, great question. When I joined, I was employee 1 to build out the risk group. Jose, all of us on this LT, there's 7 of us. Through an acquisition, through the growth of the business unit, about 300 people now, worldwide.
Over what time frame was that?
About,
4 years?
4 years, yeah. And I mean, we are, and I like to raise my hand on this one, but from a risk perspective, we are the most buttoned up group in the firm. But I like to say we have no choice because a lot of my life is fact and appearance. People just say, oh, that's just risky, or I don't get it. Why would we do that? So we have to consistently utilize best practices and then go above in order to make sure our story is appropriate.
See, I think that's a really interesting just microcosm. You're looking at one of the largest fintechs in the United States, basically going from 0 to hundreds in a couple years, and you're going to see that same thing translate through the rest of the space, I think, pretty aggressively.
I agree.
I think the story element is also a really underappreciated one, meaning to have accomplished what you did over 4 years, Larry, you in particular probably had to create very compelling arguments internally rally stakeholders. And I do know there were times when PYUSD was about to go out and then there was a pullback time and time again. You guys are founders, you're executives, so you have to also keep your employees motivated and also try and hire new talent. There are infrastructural limitations right now to the adoption of real-world assets, one of which is thin order book liquidity. We discussed this previously. For those who are part of groups which are considering investing more R&D into this space, thinking about what they could potentially build or do that's different and unique, what's on your wish list? And like from a story perspective, why is that something worth building?
I mean, I can start out. I have a real wish list. When we look at particularly the security token space, there's one thing that still has not been solved, and there's no one making markets on these assets. And until there's people making markets on their assets, it will ultimately stifle the industry by quite a bit. And I can't make markets on my own exchange, so I can't solve that problem necessarily, but we're looking to work with others to find that solution. It's a industry-wide problem. I mean, until that is solved, you're really going to be stuck. Fortunately for us, when we're doing these offerings, in the U.S., these things are locked up for a year anyway, so we have time to solve it. But that's definitely at the top of our list. There's a lot of money to be made in it too, by the way.
Absolutely.
I'd say one really good way to develop that wish list is to be a guinea pig for these products. So I didn't tell you about this earlier, but we adopted PayPal USD at Anchorage, and to rally the team and kind of to that point around leadership, I put 80% of my liquid net worth into PayPal USD.
Wow.
And to hold that inside Anchorage, just to kind of tell the team hey, we're going to go big into this. We want to spend a lot of time on stables. We want to really deeply work on this partnership with PayPal. And so now
20% of the stablecoin market cap now is your liquid.
I'm a small fish in the very big pond that is growing. But so what do I want? I want to be able to ACH out of my stablecoin account. I want to be able to wire from a stablecoin account and have it transparently converted and to use the existing rails. I want to be able to use that as collateral for a loan. I want to be able to borrow against that. I want to be able to do all kinds of interesting stuff against that asset.
Without having to off-ramp traditionally.
Mm-hmm. Without having to ever go back into dollars in a bank account. I think one of the most incredible things about stablecoins is that they're a way to hold dollars without bank counterparty risk. Yep. And I think a lot of people are sleeping on the fact that the banks are inherently risky, but stablecoins can fundamentally remove that risk. And so there's a lot of really, really fun stuff that you can do with that. And that just gets us to the baseline of that. Once we start bringing a bunch of assets on chain, we're going to want to settle these things instantly. And so the more that a leadership thing to do there is just to start using these things. Get these things into your organizations, try it out, feel it, touch it, understand what the use cases are there, and it's going to very naturally follow from that what you want to do with those assets.
That's awesome. I would say I'm very simple on this. So the Zoom cross-border payments business was integrated into our blockchain and digital currencies group, and just seeing the pain of sending remittances cross-border. And whether that's settling with our disbursement partners or whether the actual last mile of someone receiving PYUSD, et cetera. So being able to work on our roadmap initiatives there to improve that experience and also lower our own costs, that goes to my second one. Just the amount of money you can save internally from treasury operations, et cetera. I mean, in one function, I'm spending $26 million a year on wire fees. And figuring out how to integrate PYUSD into that, that's another big one. And we just launched business accounts. So we have a two-sided network. So I get to see what's happening on the consumer and the business side. And there's a lot of pain points there as well. And then also with just B2B, right? I have a coffee shop in Brooklyn, and I'm sourcing my beans from, a part of Africa. And there's problems there with settlement, et cetera. So working on that stuff.
Incredible. Michael?
Yeah, so I think that on the stablecoin front and payments, everything that was described here is definitely required. But honestly, I think there is so much velocity and so many startups over there and incumbents that are working. All those things that I think in a year from now, it will all pretty much be sorted out. I think that on the on the non-stable coin stuff, right? The things that Andrew is talking about. I think that secondary liquidity is definitely a problem right now. But I think that I guess prerequisite to that is actually that for a lot of those things we still didn't figure out the demand side, right? So I think for all those unique assets that are only either available through blockchain, or those are assets that like the money market funds, right? We really need to find the use cases in which we are able to generate demand and how to distribute it towards that demand. And I think that this is where we are currently still, struggling.
You're going to love our next conversation then.
Well, to close out this fantastic discussion, I'll say what's on my wish list, and this is very relevant to the next discussion. There are incredibly volatile incidents going on around the world. This is a heightened moment of events-based trading, and I, in particular, want to be able to have synthetic exposure to assets like gold and oil and copper. It's something that I track very closely. It's a different form of real-world assets, so I'm incredibly excited to hear what the next group's going to say about that. Thank you all. This was wonderful.
Thanks so much.